Okay guys, so we're going to get into accumulation and distribution phases / cycles. So the market is ultimately composed of accumulation and distribution cycles. These cycles are extremely important to know because they will ultimately guide a potential trade bias if you can understand if the market is accumulating orders to go up or if they're distributing orders to send price lower. Note the areas where accumulation / distribution cycle is of the utmost importance. So where the accumulation, where the distribution cycles happen, it's very paramount to having a higher probability trade. So I'm going to start off talking about accumulation. Major signs of an accumulation is when the market is consistently taking out new lows but holding a level of demand. So if we're at a support level and you start to see that the market kind of makes new lows, but then you start to see impulse moves up. The market just kind of has this unwillingness to head lower. That's typically a sign that the market is accumulating orders, especially if the price is at a specific area of support. So if it's at like an order block, imbalance, whatever, that's a very, very prominent sign. Typical signatures will be the market unwilling to really go lower and constantly have an impulse move after creating new lows, which I just mentioned. The key is identifying accumulation at a key higher time frame demand level or under a very significant liquidity pool. Like let's say if we're under a prior week low, that might be an area where we could look for some sort of accumulation setup. In the setup section of the course, I'll be going over my favorite accumulation distribution pattern. So I'm going to go into like the nitty gritty of all that stuff in the section where we talk about like the setups, the top down analysis, things like that. And we're going to get into a lot more in depth because one of the setups actually has a liquidity pool element to it. So I'm definitely going to be talking a lot more about that in depth in the later videos. So just over here, here's just a quick illustration of this. Let's say the market right here, this blue shaded box is an area of demand. Let's say it's like an accumulation, consolidation zone, order block, imbalance, it could be whatever. Once we start to see the market kind of like, it's kind of like accumulation is ultimately a consolidation. But within the consolidation, we typically will see, let's say the market makes a new low, but then we have impulse. Start to make new low, impulse. And then typically at the end of the accumulation phase, what's going to happen is you're going to see that the market starts to make a push up to the, let's say the high end of the range, but you're not going to see like a significant turn in the price. Oh, let me go back. So let's say, price starts to make higher highs and higher lows, and higher lows, and then we ultimately start to push up. Now, typically after an accumulation phase or distribution phase, we're going to see that the market has a significant run up because the market kind of took all this time to accumulate orders. Now they're ready just to kind of push price and send it up. So typically the bigger the accumulation or distribution cycle, like the longer it takes, the bigger the move typically is. So that's something you guys definitely want to take note of. And over here, I just wanted to illustrate, like if you have this as a confluence, let's say this is an area of demand, and we're under let's say a prior week low, this is also a very strong indication that the market may be on its way up. Now, distribution. Major signs of distribution is when the market is consistently taking out new highs but holding a level of supply. Typical signatures will be the market unwilling to really go higher and constantly having an impulse move after creating a new high. So this is just the inverse of the accumulation stuff. The key is identifying distribution at a key higher time frame supply or over a very significant liquidity pool. So like let's say a prior week high. In the setup section of the course, I'll also be going over my favorite accumulation distribution pattern, which I just referred to in the last slide. So here's another example of the distribution cycle. Not sure why the arrow's over here, but let's say market kind of pushing up. Let's say this is an area of supply. The market is at a resistance. It could be a bearish order block, consolidation zone. It could be a bearish fair value gap / imbalance, whatever you guys want to call it. You're going to have a level of accumulation. The market's kind of pushing, and then you'll see the market starts to decline. Similarly that we had in the accumulation phase, once the market starts to finish its distribution cycle, what we're going to have is the market kind of pushing up and then slowly start to get out of this range, right? And I'm going to show you guys an illustration of Wyckoff if you guys are familiar with that. I'm going to show you an illustration of Wyckoff in like the next video, part 2 of the accumulation distribution phase cycle, where there's this phase called phase E. I don't trade Wyckoff. I don't use all that schematic stuff because I think it's honestly just confusing, and I don't think it's any I personally don't find any value in it except for the phase E. Phase E is essentially where the market kind of, after the distribution or accumulation cycle, the market is going to kind of drift off, start to make, let's say in this example, since we're bearish, the market is going to start making lower highs and lower lows, and then we'll kind of just start to sell off aggressively. And I'm going to show you guys multiple examples of like this in part 2, where I go into trading view, show you guys actual chart examples, and then I'm going to show you the Wyckoff accumulation and distribution schematic, but only the way I use it in the phase E cycle. And again, this is just to illustrate that if we have a confluence of events, so let's say the market has a prior high in here, which is this black line, and we're at a bearish order block, bearish fair value gap, or bearish consolidation zone, or whatever you guys want to call it. This is also a very good level of confluence, and typically you'll have a very strong sell-off as well. So guys, that's pretty much that's it for part 1. This is just to introduce the concepts. In part 2, I'm going to go into trading view, and I'm going to be showing you the schematics of Wyckoff and how I personally use it to determine my accumulation and distribution cycles.